Question 1. Topic: Premium payments and calculation. How does a policyholder's age typically impact the premium for a term life insurance policy in Tennessee? A. Older policyholders typically pay lower premiums because their risk of death is lower. B. Younger policyholders generally pay higher premiums because their risk is considered higher due to the longer coverage period. C. Older policyholders generally pay higher premiums because the risk of death increases with age. D. Age does not impact the premium for a term life policy in Tennessee. Only the policy term affects the premium. Answer: C. Explanation. Premiums for term life insurance policies are based on the risk of the policyholder passing away during the policy term. As people age, their risk of death increases, which is reflected in higher premiums. Tennessee insurance companies use actuarial tables and mortality rates to calculate these premiums, and older policyholders are considered to have higher risk, leading to increased costs. The incorrect options fail to recognize that the primary factor affecting premium pricing is age-related risk and not the length of the policy. Question 2. Topic: Underwriting and risk assessment. Which of the following is not commonly considered in the underwriting process for a term life insurance policy in Tennessee? A. Smoking habits. B. The policyholder's annual income. C. High-risk hobbies or occupations. D. Pre-existing medical conditions. Answer: B. Explanation. The underwriting process for term life insurance in Tennessee focuses primarily on factors that affect the risk of premature death, such as smoking, pre-existing medical conditions, and high-risk hobbies or occupations. These are used to classify individuals into risk categories influencing the premium. While a policyholder's income may be evaluated during financial underwriting for larger or permanent policies, it is not a central factor in risk assessment for basic term life insurance policies. The correct answer, therefore, is option B, as income is not a primary determinant in the underwriting process. Question 3. Scenario-based. Topic: Policy riders. Mr. Davis, a 45-year-old non-smoker, recently purchased a term life insurance policy in Tennessee with a waiver of premium rider. 6 months later, he became permanently disabled in a car accident and is unable to work. What will happen to Mr. Davis's premium payments? A. Mr. Davis will continue to pay premiums as usual. B. The insurance company will waive all future premiums due to his disability. C. Mr. Davis's premiums will increase because of his disability. D. His policy will be cancelled because he can no longer pay the premiums. Answer: B. Explanation. The waiver of premium rider allows the policyholder to stop paying premiums if they become disabled and unable to work without losing coverage. This rider provides protection for situations like Mr. Davis's, where the disability makes premium payments financially burdensome. In Tennessee, this rider is commonly used to ensure that coverage remains in effect even if the policyholder's ability to pay is compromised by a disabling event. The incorrect options overlook the key benefit provided by this rider: continued coverage without the need to make premium payments. Question 4. Topic: Types of term life insurance. Which type of term life insurance policy has a death benefit that decreases over time, typically matching the declining balance of a loan? A. Level term insurance. B. Decreasing term insurance. C. Increasing term insurance. D. Return of premium term insurance. Answer: B. Explanation. Decreasing term insurance provides a death benefit that declines over the life of the policy, often used to cover financial obligations like mortgages, which decrease over time. It is less expensive than level term insurance due to the decreasing risk to the insurer. The other options are incorrect because level term insurance has a constant death benefit, increasing term insurance has a growing death benefit, and return of premium term insurance refunds the premiums at the end of the term if no claim is made. Question 5. Topic: Conversion to permanent insurance. If a term life insurance policyholder in Tennessee decides to convert their term policy to a whole life policy, what impact will this conversion typically have on their premiums? A. Premiums will remain the same, as the policy type does not affect the cost. B. Premiums will decrease because whole life policies are generally cheaper. C. Premiums will increase because whole life policies include a savings component. D. Premiums will decrease temporarily before increasing again. Answer: C. Explanation. Converting a term policy to a whole life policy generally results in higher premiums because whole life policies provide lifelong coverage and include a cash value component which builds up over time. Term policies are less expensive because they offer pure insurance without savings or investment features. Tennessee regulations permit such conversions without requiring additional underwriting, but the increased premium reflects the added features of whole life insurance. Question 6. Topic: Beneficiaries and policy payouts. Which of the following statements about irrevocable beneficiaries is correct? A. The policyholder can change an irrevocable beneficiary without their consent. B. An irrevocable beneficiary cannot be removed or altered without their permission. C. Irrevocable beneficiaries are not allowed in Tennessee life insurance policies. D. The irrevocable beneficiary receives the policy's death benefit in monthly installments only. Answer: B. Explanation. An irrevocable beneficiary cannot be changed or removed from the policy without their consent. This provides the beneficiary with guaranteed protection that they will receive the policy's death benefit. In contrast, revocable beneficiaries can be altered by the policyholder at any time. Tennessee law recognizes irrevocable beneficiaries as part of a life insurance contract, ensuring their rights are protected. The other options are incorrect because they either contradict the rules of irrevocable beneficiaries or are factually inaccurate. Question 7. Scenario-based. Topic: Policy termination and lapse. MS. Carter has a term life insurance policy in Tennessee and recently missed a premium payment. She is now 45 days past due. What is the status of her policy and what options does she have? A. Her policy has lapsed, but she can reinstate it by paying the missed premium and providing evidence of insurability. B. Her policy is still active and she has 15 more days to make the payment before it lapses. C. The policy has been terminated permanently and she cannot reinstate it. D. The policy will continue indefinitely without further premium payments due to a grace period extension. Answer: A. Explanation. In Tennessee, most term life insurance policies include a grace period of 30 to 31 days for missed premium payments, if MS. Carter has missed the 45-day mark. Her policy likely lapsed. However, she generally has the option to reinstate the policy by paying the overdue premium and, in most cases, providing proof of continued insurability. The incorrect options either misinterpret the grace period rules or suggest inaccurate outcomes for a lapse policy. Question 8. Topic: Tennessee Department of Commerce and Insurance Oversight. Which of the following is one of the primary responsibilities of the Tennessee Department of Commerce and Insurance regarding life insurance policies? A. Setting premium rates for all life insurance policies sold in Tennessee. B. Approving all policy forms used by life insurance companies in the state. C. Paying death benefits directly to policy beneficiaries. D. Administering group term life insurance policies for employers in Tennessee. Answer: B. Explanation. The Tennessee Department of Commerce and Insurance oversees life insurance regulations, including approving policy forms to ensure they comply with state laws. The department does not set premium rates or administer policies directly. Premiums are determined by insurance companies based on risk assessments, and employers or insurers handle group policies. The incorrect answers describe roles outside the department's regulatory authority. Question 9. Topic: Claims process. During the claims process in Tennessee, what is typically required before the insurer can process a death benefit payout? A. Proof of income from the deceased. B. A notarized letter from the primary beneficiary. C. A certified copy of the death certificate. D. The policyholder's will. Answer: C. Explanation. In Tennessee, a certified copy of the death certificate is the primary document required to initiate a death benefit claim. Insurers need this official proof of death before they can process a payout to beneficiaries. The incorrect options either provide unnecessary or irrelevant documentation, such as income proof or a will, which are not required for most standard life insurance claims. Question 10. Topic: Policy riders. What is the main purpose of the accelerated death benefit rider in a term life insurance policy? A. It increases the death benefit payout if the policyholder dies in an accident. B. It allows the policyholder to access a portion of the death benefit before death if they are terminally ill. C. It waives premium payments if the policyholder becomes disabled. D. It extends the policy term automatically upon expiration. Answer: B. Explanation. The accelerated death benefit rider allows policyholders to receive a portion of their death benefit early if diagnosed with a terminal illness, providing financial support for medical expenses or other needs. The incorrect options describe other riders, such as accidental death. A. And waiver of premium. C. Option D. automatic extension of the policy term is not a feature of the accelerated death benefit rider. Question 11. Topic: Advantages and disadvantages of term life insurance. Which of the following is a key disadvantage of term life insurance compared to permanent life insurance? A. Lower initial premium costs. B. Coverage lasts for a limited period. C. Lack of a cash value component. D. High fees for policy changes. Answer B. Explanation. A significant disadvantage of term life insurance is that it only provides coverage for a specified term, after which the policy expires, leaving no death benefit. Permanent life insurance offers lifelong coverage, regardless of age, while term policies typically have low initial premiums and do not build cash value. C. These are advantages or characteristics of term insurance. Option D about high fees is not universally applicable to term policies. Question 12. Topic: Policy structure and provisions. Which of the following provisions in a term life insurance policy allows the policyholder to extend their coverage without undergoing additional medical underwriting? A. Conversion provision. B. Grace period provision. C. Renewability provision. D. Non-forfeiture provision. Answer A. Explanation. The conversion provision allows policyholders to convert their term policy into a permanent policy without undergoing medical underwriting, typically within a specified time frame. The grace period provision B allows a short time for late payments, while renewability provision C allows for the extension of the term but may involve higher premiums. Non-forfeiture provision D is not applicable as it relates more to permanent policies. Question 13. Topic: Tennessee-specific life insurance regulations. What is the maximum period during which a policyholder can contest a life insurance policy in Tennessee based on a misstatement of age or gender? A. 1 year. B. 2 years. C. 3 years. D. 5 years. Answer B. Explanation. In Tennessee, a life insurance policy can be contested for a misstatement of age or gender within 2 years of issuance. This is consistent with the contestability period during which insurers can review the accuracy of the information provided by the policyholder. After this period, claims cannot be contested based on such misstatements, reinforcing consumer protection. Question 14. Topic: Taxation of term life insurance. Under what circumstances may the death benefits of a term life insurance policy be subject to federal estate taxes? A. If the policyholder's estate is valued above the estate tax threshold. B. If the beneficiary is a corporation. C. If the policyholder designates an irrevocable beneficiary. D. If the policy was converted to a whole life policy. Answer A. Explanation. Death benefits may be subject to federal estate taxes if the total value of the policyholder's estate exceeds the estate tax threshold, which is set by federal law. Designating a corporation as a beneficiary. B. Or naming an irrevocable beneficiary. C. Does not inherently trigger estate taxes. Converting to a whole life policy. D. Does not directly affect estate tax liability, but the policy's value may influence the overall estate value. Question 15. Topic: Claims process. If a life insurance claim is filed after the contestability period has ended, which of the following statements is true regarding the insurer's obligations? A. The insurer can deny the claim based on information provided in the application. B. The insurer must pay the death benefit regardless of the circumstances. C. The insurer can only contest the claim for fraud. D. The insurer can require the beneficiary to prove the cause of death. Answer C. Explanation. After the contestability period, typically 2 years, in Tennessee, an insurer can only deny a claim based on fraud or willful misrepresentation in the application. Claims cannot be contested based on the accuracy of the information provided once this period expires, ensuring that beneficiaries are protected from unjust denials. Option A is incorrect, as the insurer cannot deny based on application information after this period. Option B is overly broad, and option D relates to claim requirements that may not apply. Question 16. Topic: Underwriting and risk assessment. Which of the following factors is least likely to affect the underwriting process for a term life insurance policy? A. The applicant's credit history. B. The applicant's medical history. C. The applicant's lifestyle choices, e.g. smoking hobbies. D. The applicant's age and gender. Answer A. Explanation. While an applicant's medical history B. Lifestyle choices. C. An age and gender. D. Are critical factors in determining risk and premiums during the underwriting process. Credit history A is typically less relevant for life insurance underwriting. Insurers focus on health-related risks, mortality tables, and lifestyle risks as these directly impact life expectancy and potential claims. Question 17. Topic: Beneficiaries and policy payouts. In Tennessee, if a policyholder designates their spouse as the primary beneficiary and their spouse predeceases them, which of the following options correctly describes the policyholder's next steps? A. The policyholder must name a new beneficiary to receive the death benefit. B. The policyholder's estate automatically becomes the beneficiary. C. The death benefit is paid to the contingent beneficiary if designated. D. The policyholder's children will automatically receive the death benefit. Answer: C. Explanation. If the primary beneficiary predeceases the policyholder, the death benefit typically goes to the contingent beneficiary if one has been designated. If no contingent beneficiary is named, the policyholder must update their beneficiary designation. The estate B may become the beneficiary if no valid beneficiary exists, but this is not the default action. The children D do not automatically receive benefits unless they are named as beneficiaries. Question 18. Topic: Types of term life policies. Which type of term life insurance is specifically designed to cover a mortgage balance that decreases over time? A. Level term insurance. B. Annual renewable term insurance. C. Decreasing term insurance. D. Return of premium term insurance. Answer: C. Explanation. Decreasing term insurance is structured to match the declining balance of a mortgage, making it suitable for homeowners. The death benefit decreases as the mortgage balance reduces. Level term insurance say it maintains the same benefit. Annual renewable term B allows for annual renewals at increasing rates and return of premium. D provides a refund of premiums if no claims are made, but does not align with a mortgage structure. Question 19. Topic: Policy riders. What does the waiver of premium rider in a term life insurance policy accomplish? A. It allows the policyholder to skip premium payments if they become disabled. B. It increases the death benefit amount in case of accidental death. C. It provides an additional sum of money for funeral expenses. D. It guarantees renewal of the policy regardless of health changes. Answer: Explanation. The waiver of premium rider enables the policyholder to waive premium payments if they become disabled and cannot work. This ensures continued coverage during times of financial hardship. The other options, B, C, D, describe benefits that are not part of this rider. The rider is especially valuable as it protects the policyholder's coverage during periods of disability without losing benefits. Question 20, scenario-based. Topic: Ethics and suitability in Tennessee life insurance sales. Mr. Thompson, a life insurance agent, is reviewing a policy for a client who has expressed a desire for lifelong coverage but is only considering a term policy due to its lower premiums. Mr. Thompson knows that the client is in poor health and might not qualify for a permanent policy later. What should Mr. Thompson do to ensure he acts in the client's best interest? A. Recommend the term policy and inform the client they can convert later. B. Encourage the client to consider a permanent policy now given their health status. C. Suggest the client save the difference in premiums for future needs. D. Advise the client to purchase the term policy and discuss conversion options after the fact. Answer: B. Explanation. Mr. Thompson should encourage the client to consider a permanent policy given their poor health status, as this may be the best option for ensuring coverage without future complications. Although term policies are cheaper, they may not meet the client's long-term needs. Option C, saving the difference, does not address immediate needs for coverage. And D, delaying discussion of conversion is not acting in the client's best interest. The agent's ethical obligation includes prioritizing the client's financial needs and long-term coverage goals. Question 21. Topic: Term life insurance features. What is typically true about the premiums of level term life insurance compared to decreasing term life insurance? Level term premiums decrease over time. B. Decreasing term premiums remain constant over time. C. Level term premiums are usually higher than decreasing term premiums. D. Decreasing term premiums are always more expensive than level term premiums. Answer: C. Explanation. Level term life insurance typically has higher premiums compared to decreasing term life insurance, which has a death benefit that decreases over time, reflecting the decreasing risk associated with the insured. as the death benefit declines, the premium for decreasing term policies is generally lower. Question 22. Topic: Underwriting process. During the underwriting process, which of the following factors is least likely to influence the insurance company's assessment of risk? A. Family medical history. B. Geographic location. C. Personal credit score. D. Marital status. Answer: C. Explanation. While family medical history, A. Geographic location, B. and marital status, D. can influence life expectancy and risk assessment, a personal credit score, C. is less relevant in life insurance underwriting. Insurers focus primarily on health-related factors and lifestyle choices. Question 23. Topic: Contestability period. In Tennessee, what is the duration of the contestability period for a term life insurance policy? A. 1 year, B. 2 years, C. 3 years, D. 5 years. Answer: B. Explanation. In Tennessee, the contestability period for life insurance policies is typically 2 years. During this time, insurers have the right to investigate and contest claims based on misstatements or omissions in the application. After this period, the insurer can only contest a policy for fraud. Question 24. Topic: Death benefit disbursement. Which of the following best describes how the death benefit is paid out in a term life insurance policy? A. As a lump sum payment to the insured's estate. B. As a series of monthly payments over a specified term. C. As a combination of a lump sum and annuity payments. D. As a tax-free lump sum to the named beneficiary. Answer: D. Explanation. The death benefit of a term life insurance policy is typically paid out as a tax-free lump sum to the named beneficiary upon the insured's death. This payout is immediate and does not involve payments to the estate unless there are no designated beneficiaries. Question 25. Topic: Policy riders. What is the primary benefit of adding an accidental death benefit rider to a term life insurance policy? A. Increases the death benefit if the insured dies from natural causes. B. It provides additional coverage if the insured dies in an accident. C. It ensures the premiums are waived in case of disability. D. It offers a cash benefit if the insured becomes terminally ill. Answer: B. Explanation. The accidental death benefit rider provides additional coverage and increases the death benefit if the insured dies as a result of an accident. This rider enhances the financial protection for the insured's beneficiaries, distinguishing it from benefits that pertain to natural causes or other conditions. Question 26. Topic: Exclusions in life insurance. Which of the following is a common exclusion in a term life insurance policy? A. Death resulting from a car accident. B. Death due to suicide within the contestability period. C. Death from natural causes. D. Death from a specified illness. Answer: B. Explanation. Most term life insurance policies commonly exclude death due to suicide within the contestability period, typically 2 years. After this period, the insurer cannot deny claims based on suicide. Death from car accidents, A, or natural causes, C, is usually covered, and specified illnesses, D, may be covered unless explicitly excluded. Question 27. Topic: Conversion options. What happens to a term life insurance policy if the policyholder opts for conversion to a permanent policy? A. The premiums will decrease. B. The policyholder must undergo medical underwriting again. C. The death benefit may increase. D. The policy will terminate immediately. Answer: C. Explanation. When a term life insurance policy is converted to a permanent policy, the death benefit may increase to reflect the nature of permanent coverage. Generally, the conversion does not require additional medical underwriting, although the premiums for the new policy will typically be higher than those for the term policy. Question 20. Topic: Life insurance premium calculations. Which of the following factors most directly influences the premium of a term life insurance policy? A. The policyholder's investment portfolio. B. The insured's health status. C. The type of beneficiary designated. D. The geographic region of the insurer's headquarters. Answer: B. Explanation. The insured's health status has a direct impact on the premium for a term life insurance policy, as it affects the insurer's assessment of risk and mortality. Other factors like investment portfolios, A, or the insurer's location, D, do not directly influence the premiums. The type of beneficiary, C, does not affect the premium calculations. Question 29. Topic: Life insurance regulation in Tennessee. Which agency is responsible for regulating life insurance companies in Tennessee? A. Tennessee Department of Revenue. B. Tennessee Department of Insurance. C. Tennessee Health Department. D. Tennessee Bureau of Investigation. Answer: B. Explanation. The Tennessee Department of Insurance is responsible for regulating life insurance companies operating in the state. This department oversees compliance with state laws and consumer protection regulations, ensuring that insurance providers adhere to established standards. Question 30, scenario-based. Topic: ethical sales practices. Maria, a licensed insurance agent in Tennessee, is meeting with a potential client who is considering a term life insurance policy. The client expresses concerns about affordability. To act in the client's best interest, what should Maria do? A. Recommend the most expensive policy to maximize her commission. B. Provide a range of term options and discuss the benefits and drawbacks of each. C. Encourage the client to skip coverage entirely to save money. D. Pressure the client into a decision to close the sale quickly. Answer: B. Explanation. Maria should provide a range of term options and discuss the benefits and drawbacks of each to help the client make an informed decision. This approach ensures that she acts ethically and considers the client's financial situation and needs. Recommending the most expensive policy. A. Or pressuring the client. D. Is unethical while encouraging the client to skip coverage. C. Does not serve their best interests.